Okay, good morning, folks. Just a little bit of a live exercise here. We had these down close candles in here. Prices moved through it. We had a down close candle here. Prices moved through it. So I'm watching this candle right here as a potential bullish order block and a run on liquidity above these highs here. And 10 pips above that would take us to 127.75. So I'm going to go long with a stop below this area right here. So again, my draw on liquidity is there. And that would take us to, we'll highlight 80 as our upside objective. That's our next institutional level. And that'll be up there. So institutional order flow, as you can see, and I'll recap it at each stage here so you can see it. We'll just use a rectangle just to highlight the order block. Okay, so I'm using the upper half of the order block at each, just to give you a graphic depiction. When there's consecutive candles, I'd use the entire body of both. Okay, and I'm just eyeballing it. It doesn't have to be perfect because all of these levels would be calibrated if you were going to trade them. And since they've already passed, we're just making an illustration of the underlying concept. Here, that's the order block here. So I'm using 50% of that range being right there. And same thing here. From the high to the midpoint. Okay, and again, this is where the stop would be. And I am on demo with this, so you guys know. And we're going to watch how this trades this morning. And we'll see if we get a draw on liquidity up to that institutional 80 level. And I'll have one more example I can share on Twitter as the first engagement for 2019. Okay, and when we're looking at price action, it's important that we quickly determine what the institutional order flow is. That's the first objective when we're going through price. We're looking for those elements to suggest to us where the next draw on liquidity is going to be. And if it's bullish, we look for specific PD arrays, as you'll learn in month number 5 content. As it is, you see here, we've made many attempts really to try to go lower. We have many lows, and here we have this low, we went below it, then traded higher. This low, we went below it, came back up, rebalanced, and then this low was again taken. Then we came all the way back up here, took the liquidity here, came all the way back down into the range from this low to this high, trading right back into this order block, the mean threshold of this order block here. So if we were to measure the high down to the low, about 50% of that is here. Okay, so that's typical. That's more or less the allowed portion of price action to move against this low without running the low. It would be preferential for us to not see it trade down to the middle of the candle to the mean threshold, because it's actually more bullish to do that, or not to do that, I should say. But we allow for those types of things when we're looking for setups or for framing institutional order flow, which is really the basis of what I'm showing you here. When we identify down close candles that are potentially bullish order blocks. We're really focused on the upper half of that candle. Anything below the mean threshold of those candles would be indicative of a change in institutional order flow or the underlying momentum. So when we're looking for things to justify a trade or a setup, there's a lot of balancing acts. And I mentioned this last week when I was on Twitter. The golden rule of investing, and I learned this from Larry Williams, and it makes a lot of sense still to this day. It's when we're trying to find a opportunity to profit. In other words, if our motivations are at present looking to make money or profit, our actions around that process or endeavor is to go slowly. Go slowly, because if you go quickly, it's easy to latch onto an idea just because you have time to do so. So if you have a job, if you have a business, or um, is a time of day or a kill zone that permits an overlap of where you can engage price action, it's not that we want to sit down and say, okay, let me fill in my little space of time with a trade because price is always moving, so therefore I always should know what's going on. That's not an accurate depiction of what a new trader or neophyte should expect. But if we know that there's a likelihood that there is a setup there, then we can go through the processes like I outlined here. Now, obviously, these things would be done in advance, but it only took me a second to see the overall setup of where we're at. And I did it literally live as I did the recording. So the reason why I'm comfortable with a long in here, and even though it looks like we're above this range high here, so therefore that could be a turtle soup sell, I don't believe so. The institutional order flow behind us from present price action, or when we were looking at it prior to it moving up, was we are shortly after 8 o'clock in the morning New York time. We're approaching right now. The time is 8:26, 8:27 probably. Yeah, almost 8:30. So there's a typical price action volatility injection that takes place around 8:30. Usually it's news event driven. But truth be told, I haven't looked at the economic calendar because I've been answering a lot of emails regarding to our website. And I just want to put a video out this morning, and I'm throwing it on YouTube simply because I want to be able to communicate with you. Some of you are new, a lot of you are new students now, and this is our first real technical hiccup that we've had with the server that I use, HostGator. They get me a notice that they're going to be updating my hardware that they use to manage the data that I have, but for whatever reason, I guess it's because we have so many videos. It's given them a little bit more work than I guess the average website. I guess I don't know, to be honest with you, but I still want to be able to reach out to you. So this video is unlisted. Obviously, it's not to be shared with anyone. It's not the intent because it is technically still a mentorship property. And once the website is restored from the server standpoint, when they do their updates, this link will be populated on the server there, and it won't be left on YouTube. So, but nonetheless, I wanted to engage with you guys this morning, just remind you that we're doing business as usual. Nothing's changed. Okay, it's just I can't use my normal medium, and you don't really have access to lessons until they update the server. And the first email I got was about 12 hours ago. Yeah, about 12 hours ago from now, that that members were unable to get access to the links. They could get into the forum, which obviously tells me that it's not the forum website that I use as host. It was the server. And then when I tried to sign in myself, it gave me the same 500 internal error, which they're working. They have an administrator working on the actual website and server. So I spoke with them this morning at 7:30. They kept me online for about 25 minutes back and forth, and they confirmed that they are actively working on it. So we're going to have to be patient and give them time to do whatever they're going to do. So, truth be told, I am actually a little bit anxious because we have like 600 videos, and when I have to upload all that stuff again, that would be nuts. But nonetheless, we're watching price action in here. Everything looks as if it will want to move to our old high here at 127.65 at the very minimum. That doesn't really give me much room to profit. I need at least, in my mind, 15 pips to do a scalp. So if I can't get 15 pips out of it, I don't like it. And this is the framework that I'm using here. I can see 15 pips as a likely upside for this scalp. It doesn't mean that I'm going to take everything off at that, but just means that I could take something off to present an opportunity, because it's really too early in the year for me. And if we didn't have the technical issues right now with the website, that I wouldn't be doing this at all. But it's more or less just to calm and comfort the new people, because I'm sure it was probably nervous feelings and apprehension about sending your first payment and signing up, because everything changes when there's money. And now that we have this is the first, like I said, the first technical issue we've had, which has been surprising considering what technology can do today. You still end up with issues once in a while. And we've been, knock on wood, praise God, that we haven't had a lot of these types of things occur. But I feel as if I have to come on here and just to remind everyone that I haven't disappeared. I haven't closed up shop. I know some of you are foreigners. They're not American. And folks in America, if I send them a real quick email when they send something to me, I say, hey, look, I'm on it, just relax, and they're cool with that. It settles them. But a lot of the folks in other countries, they get paranoid and they inundate me with 1,000 emails. And until things change on the web servers front, I can't do anything from where I am except for what I'm doing now. So just to appeal to your patience and just to remind you that you don't need to be concerned. There's nothing going on right now. And in fact, it's still the time of year where we're not really in a position where we should be actively engaging for live trades. It's just the volatility is a little quirky still. We're doing exercises only. And if this was live money, I would not be in it. So just for clarity, that's what we're doing here. But I wanted to show you that when we do exercises, we're focusing on time of day, kill zones, reading institutional order flow, and because it's a scalp, it's really not that imperative that we use the higher time frame. It makes it better. And I'm not saying that you should go in here and try to trade without the top-down analysis. I'm just giving you something real quick off the cuff because I want to be able to speak to those individuals that are members and just settle them down, because they're basically panicking. Don't panic. There's no reason to be panicking. It's a normal business opportunity for the company I pay to host our website links and videos. They're doing whatever they can, I guess, to make the experience better for us as the user. So because it's outside of me, it's a third-party issue that I use to maintain and operate this service. I'm at the mercy of whatever time frame it takes for them to get whatever it is they're doing done. But I'm also obligated to you all to still be able to communicate to some degree what is going on and how we can stay abreast of that. So we're watching to see if we want to go back below this high here. Ideally, it probably, in the best case scenario, it shouldn't want to do that. But we have a little bit of an efficiency right in here. So when I'm looking at things like this, what I'm thinking while I'm watching it is it's normal to anticipate some measure to want to get back below that high. If it does, I'm watching this level. And I want to see if it trades down to that level. I want to see support and a rejection away from that level, because it's only buy side delivery right in here. So there's an imbalance. What kind of imbalance is that? It's a buy side imbalance, sell side inefficiency. There's not enough selling in here to balance out that one singular move between this low and this high. So I'm going to frame that like this so you guys can see it. So if it drops down here, this will be another area to buy, and if it does, I'll add another, I'll put a single lot in there. I'll go long there again just to illustrate, and then the stop needs to be the same here, and that's why I'm going with one contract, one standard contract. You can hear the futures contract trader in me. If it trades down there, we can go long at the market, and you would have your orders sitting on your screen ready to go, and as soon as it hits this level in here, right below the low here, if it would print that live, I would hit it. I would not try to time it as it hits the actual low point of this range, because you may not get it. It may not happen for you. In other words, when you hit it, you still end up probably with something up here because it will be so fast and filling you, especially if you're trading with a live account. But if we see price drop down in here, we've already traded down into the order block here. So I'm going to remove that. That's not my focus right now. And this candle, okay, we've had work in here. If we traded below this range, I would expect it to trade into this one. In other words, we would see the top of this range. That's where the line in the sand would be for me. I would not want to see price trade down below this candle's high right here. And the reason why is because if we trade down below this candle's high, we've already spent time in this candle, and we left it, and we opened on this one and traded back down almost into this one as well. I don't see any necessity for it to trade get to this level. So what would that mean for me? It would mean that the stop here is going to be protected, and I would collapse the trade. Or if it was a better time of year where it's not the beginning of the year and volatility would be normal and delivery would be normal, I would just take half the position off and leave the remaining portion on with the same stop. Because of the elements that are around this whole idea, because it's really just to show you a New York trade on a Monday, same type of thing I teach in month one, low resistance liquidity runs, and this is all this is, and we're using a kill zone, we're using institutional order flow, and we're using the 8:30 in the morning like sweet spot in terms of time of day. That's one of them. Just like 3 a.m., those are typical high sensitivity markers in terms of time of day. So we're going to sit here and just watch this. I'm not going to say too much about anything. If it becomes an opportunity to do so, I'll speed the video up for the editing purposes. But if it's not drawn out in terms of time, I'll just let it play normally in your playback version of the video. So we're looking at how price is trading basically at this old high here. So now standard retail theory will be this is resistance, so therefore price should drop down and maybe drop down to this low here. We don't focus on retail here. We do look for signatures that promote the idea that retail would buy into. So in other words, as we drop down here in this price point here, again, like I said, if it trades to that level, I will go in for one more standard lot long using the same stop, 127.47. From an institutional standpoint, again, the idea is price isn't going to hit this level and say, okay, now there's sellers, so now it drops. What it's going to do is it's going to seek liquidity above this high. It's not that we look for highs and lows to bounce off of. We look for where existing orders would be residing. Okay, so we had a nice little reaction down here from this high down here. So there's shorts that are in this position or in this market. They've all been trying to sell the British pound. We had a huge volatility event last week, and we've given up all of that range, and now we're about to press to the higher end. All of the liquidity resting above, let me get this out of the way, all the liquidity above this high is what's going to be attacked all the way up into the institutional 80 level. So that's the framework of what makes price move. It's not that it's looking for old highs and old lows to find support and resistance at. That's not what goes on in the marketplace. What we see is a result of the market running to obvious levels of liquidity, pockets of liquidity, or they engineer liquidity. The run from this high down to this low, then the subsequent rally up here, and then drop down. This high and this high are relative in basically the same price level. We don't have the conviction behind the idea of double tops and double bottoms as resistance or support ideas. We look at them as retail traps or engineering of liquidity. So we have this high and this high here. Now they're not close to such a degree where you can say, well, that's a double top. But the way I classify it, and because of the narrative I just outlined, and that being this high all the way traded down to here, someone was short in here. And if they had a stop loss at that high or just above it, they're gone now. My suspicions are that because right above this high, under 20 pips, we get to the 80 level. There's a larger pool of liquidity around that 80 level because banks like to do a lot of their volume around the 80s and 20s, 50s, and full handles, 0-0 levels. Okay, so while we do have this initial run here, and can price drop all the way back from here and run my stop? It can. But what I'm watching is, see you have this down close candle? I want to see price find support in here. So far we've seen initial suggestions of that. So we're going to be monitoring this live, see if we get support in the form of new buying right in here. And all we're doing is tracking institutional order flow. Not changing our mind because we saw this real quick little down close candle. You didn't see any excitement in my voice. I wasn't concerned about it because everything here is normal business models. Price drops down, picks up more orders, then looks for expansion. Price rallies up into new liquidity. If it has an opportunity to grab more before it reaches its terminus, and I'm not saying that the high of the day is going to be 80, I'm stating that the range of liquidity that it should seek to attack or raid into is up above here and up into 80. So if I can get 15 pips off, I will. But I will try to leave something on because we could see the 128 big figure today. So we're watching price action. If now, because we have a different shift in the liquidity conditions of this particular pair, we have an order block in here. If we trade down through this and we hit this level here, this would have to support now, and my stop can be raised to just below this down close candle's low. Why am I doing that? Because there's conditions in the marketplace, and let me adjust my stop in my open position. Hold on one second. So the stop is going to 127.51. Okay, and I don't want to see price ideally go below this down close candle. I don't want to see that. But if it does, I'm allowing it to trade back down to the fair value gap, which also, incidentally, is we use the low here to high. Look what falls right at that. If I can get to let go of this. I am so clumsy with this app. That's why I love MT4. It's archaic and old, but I love it. I'm a happy dinosaur in MT4. So right here at the 50 level, that completely closes in that fair value gap. Now, is that coincidence? I don't think so. So if it trades down there, I'm completely comfortable with that. I'm not abandoning my idea or my trade view. It just means that I could pick up another order down there, and that might be the next level of volatility, and then we see a next leg of displacement to the upside. But everyone else will see this as resistance being sold, and they will chase this thing down here and go short chasing it. I'm looking to buy it because I think the liquidity and the draw on liquidity is up here. With that, I'll add that notation here. Okay, and I'm just going to I'm going to open up another order in case we get that run into that fair value gap, and I'll pick up one more order, and that would get me long another standard lot when I'm already long 5 standards. And let me get that started here with this. And the stop would go in at, well, this one I'd have to open up because the spread on stops have to be at least 10 pips. So it would have to open up at 47. And I'll use 80 as an exit on that. Again, should it trade down to this level here. Now you're probably saying, well, wait a minute, you just raised your stop up to here on your 5 lots. And I did. And if I get another entry here on 1 standard, my stop would have to be down here because I'm managing the existing spread requirements. When you use brokers, they require you to have 10 pips difference. As a futures trader, you don't have that problem, but it's one of those things you have to encounter and overcome as a forex trader. It's not impossible, it just makes it a little bit more work. But because it's 1 standard lot, that's what I'm building in. I'm building in the fact that I'm adding more, but I'm not increasing like a pyramid. Like I do 1 contract, then 5 contract, then 10 contract. That's an inverted pyramid. It's unsustainable if you have a reasonable retracement. It just eats up too much of your equity. So when I build a larger position with an existing idea that I still believe will pan out, I will go lower in terms of my lot size than my initial position entry. So I've already disclosed I did long 5 standard lots on this trade idea, and I've framed out the likelihood where I could pick up 1 more entry, but I'm not going to do 5 more standards. I'm not going to do 2 standards. I'm going to do 1. Why did I pick 1? Because of looking at this low, everything I framed out as far as what were the catalysts that make me want to raise the stop, I outlined. And because I've already outlined the fact that my stop now is at 127.51 on the 5 standard lots, if I get another entry here and I take it as a single standard lot entry long, the stop has to be 10 pips below that. So that puts me at 127.57. I'm sorry, yeah, 127.57. 10 pips below that would be 127.47, back where we started with the original 5 lot position. So it allows me to manage the trade. I can pick up another order, and I don't break any equity protocols where I'm not over leveraging because it's 1 standard lot, even though it's a slightly wider stop. And if it goes down to this price point, and it may not do it, but if it did, and it allowed me to rally back up into another level of profitability, then I could raise that single stop on the 1 standard lot up to where the 5 lot stop would be. And then I would manage them both together consecutively. So you can see the elements of retail are really struggling here. The components that make up the classic idea of support and resistance theory, it's been decimated here. Just because we have an old high and price turned here doesn't in no way indicate that because we traded there again, it's going to go back down. That's a fallacy. We're looking for where the market's going to trade to. That's the real key to understanding what I'm teaching, because we spend more time understanding where price is going to try to reach for, and that's why I call it a draw on liquidity. Think of it like a magnet, okay? And it's going to want to press up into that price level. If we know that that's the process of how we internalize price action, on any time frame, it's the same elements to it. So if we have that understood and fully appreciated, you can go back to just month 1 content and start to frame out your foundation to your unique trading model. Truth be told, your number 1 month content is enough to do everything you'd ever imagine in trading, because it gives you the playbook at which every type of high probability, low resistance setup would look like. What they look like, how they frame, how to engage them, what do they look like in price action, what do they look like leading up into it. Everything that you would need is in month 1. I did that for a reason, because I wanted to show you immediately how do you go into the market and frame ideas where you can immediately start building experiences to have a great deal of experience to pull and draw from while you're watching price action. Because if you don't understand, like I gave many times in analogies about how if we were in the woods, say I was a hunter. I'm not a hunter. I don't do those types of things. I can't kill an animal. I will do it if I had to eat it, okay? But I don't choose to do it because I just don't have it in my heart to kill something. But if I were an experienced hunter and understood how to track the animals that I would be hunting, I would be able to show you in the ground or in the snow, whatever, and say, look, this is the deer track. Okay, this is the bear track, and you can see the paw prints and the claws and such. If I point to the ground and I show you what they look like, I've done the work. Your job as the student is to retain the insight and knowledge of that image. You want to be able to see what it looks like. What's the stride distance between each time you see a new track mark? And how fresh is that mark? All those things are indicative of how long ago was that track made in the ground. So therefore, it gives you a close idea, or to an experienced tracker, how far away ahead that animal may be. If the animal's been shot with an arrow or a bullet, it may be bleeding, and you'll be tracking that same animal, okay? And how fresh that blood is, and not to be graphic, I know it's not something pleasant to think about, but it's a very strong analogy because you have to rely on what you've been taught and you have been shown by experiences. So if we know that the probability basis of trade setups are hinged and framed on reoccurring conditions and characteristics, your job is to, number one, be in the marketplace looking for what you've been shown. So it's one thing for me to sit down here and say, okay, this is a buy, and this is the reason why it's a buy. And it's profitable for you to understand that from a example basis. But it's not profitable for you to rely on that as a steady diet, because if the role is as a teacher to teach you, and if I was a hunter and I'm trying to teach you how to hunt, it's not your job to rely on me, or even should be your goal to do that, because it makes you codependent. You want to be independent. You want to be able to do these things entirely on your own. So if we have example after example of showing what they look like, what goes through the mindset, for instance, what happens if that same tracker or hunter encounters a moment where they can't see the tracks anymore? In other words, they've been tracking the animal, all of a sudden the tracks stop. What does that mean? What's the procedure at that point? Well, that's kind of like where we're at right now. We're tracking smart money. We want to see where it's likely to go. Well, an experienced tracker would see the direction those tracks are heading, and there may be a water source up ahead that it may be going to, or it could be going back to its den. All those things are what experience teaches the hunter or tracker. I'm just trying to show you what these things look like in price action, so that way you have a log of what they look like in terms of experiences. They're all going to look slightly different, but they're all going to be generally the same setup. And that may sound contradictory, but it's the truth. All of them are moving to a specific price level. I teach you how to arrive at what that price level might be with a high degree of accuracy. Knowing where it may try to reach up to or down to frames the setup, but that is not the trade. The trade is, where do you get in at between where the market is and where that market may be reaching up into in this example. So what I did was I outlined the elements that led to that down here. So we had a bullish order block we traded off of. Then we created a fair value gap. So then we have a contingency plan for those individuals that want to have a little bit more confirmation, if you will, but still be able to frame it in such a way where the risk is still appropriate. For instance, if we were buying on this order block retest here, where we open and trade down into it, that's not too far away in terms of proximity that we could use this as our initial entry. So don't think for a moment that you had to get this one because maybe you wouldn't have used that one. That's fair. But now we have this. So if price were to ever trade back down into that, prior to running the midpoint of this range up here, if we go up to the midpoint, I would not take this as a new entry because we've already extended into, ran above this high to a degree where maybe that would have already eroded all of the existing liquidity. And any time of retracement back down may not be constructive for me for a long idea because it may have already done its work running the stops. So it should run up and into it now. Everything from a framework standpoint, it's there. We've had multiple hits into this order block. We opened, traded down. We opened up here, traded down into it. We opened, traded down to it, expanded. Didn't need to go to it here, and now we're looking to press into a higher high for today. It should be a quick run with a large expansion candle, maybe 1 or 2 candles, but all the work should be done on a 1 or 2 candle basis, making it a run on the liquidity over here, and then reaching for the 80 level, not giving traders an opportunity to think, oh, well, it's time to buy. So we're going to watch this, see how it pans out. Again, the stop's unchanged at 51. Now this is enticement to get traders to want to sell this. Again, still close to this high here. Traders are going to see this and say, okay, we're not able to go higher. They may come down with a big red down candle. If it trades into this, it would still be a viable entry because we haven't traded to the middle of that gap between the institutional level where I think price is going to go to and where that old high is. If we trade above the midpoint of that, I have to raise my stop up to just below this low here. And that means the fair value gap would be not a new entry. It would be now an area where I will limit my risk. Okay, there's our run on liquidity as explained. So our stop loss would go to below this low here. And again, I'm not jamming it up in there. I'm managing the trade without feeling I'm going to get stopped out. That's the one thing you don't want to do. You don't want to be jamming your stop loss in to a position now you're going to be worried about getting stopped out. If we trade to 80, that's the objective. We want to see it try to trade to it and through it a little bit. So the question is how much do I take off the trade? You're probably thinking, how many of the 5 I was only able to put on. So I'm going to remove this fair value gap. That's not imperative that we see that or track it now. Clean up the chart a little bit. These ideas have already been expired. So since I have 5 on, we have a lot of days still. It's 9/13, basically quarter after 9. So I have a little bit more of a daily range still. I would like to take off 4 and leave 1 on to see if we get any kind of expansion on the upside today. So should we trade at 80, 4 standard lots will come off. I'm trying to get 27.82 because my fill after hitting the order block was 127.62. So we had basically a 10 pip run above this old high, the old high being 65. 75 is here. So we had a 10 pip run above the high. I'm waiting to see if we get a run to that 80. This makes more sense logically that it's going to try to reach for that round number 80. Doesn't have to. I could be wrong in that instance, but that's the framework I'm working on, because we have time of day still allowing that potential upside. I'd like to see it create like a little down close candle in here and then gap up and make a strong run up into and above 80. But you're looking at this chart, and while you're probably underwhelmed because it's not that much of a price move in terms of pips, imagine this being a hourly chart, okay, or imagine it being a 4-hour chart or daily chart or even weekly chart. The only thing that's changing is the duration of the idea panning out. The same elements that I used to frame this trade here as a scalp is the same that we would have been using for a one shot, one kill, or a long-term position trade, or a intraday day trade, working the entire daily range. Price is price. It's going to reach for liquidity. So the question you are likely to encounter, if you haven't already, you will, is, well, how do I know which liquidity is going to run to next? Well, it's all dependent upon on what time frame you're looking at, because there's liquidity on every time frame. It's better for you to trade in the direction of the higher time frame draw on liquidity, because you have the higher time frame institutional order flow behind you, kind of like the wind in your sails. It's easier to get to your trade objectives that way. When you're trading on the lower time frames, like this 5-minute chart, it's not as imperative, but it should be done, especially as a developing trader. But over time, when you get experience, you'll know how to look for liquidity pools and runs on liquidity that will be many times contrary to the daily institutional order flow. So what were my catalysts this morning was the fact that we had the amazing rejection on the low from last week on cable. So we had that more or less a black swan event that I was looking for the first week of December. We had a real big meltdown on British pound. So right now there's a huge squeeze on shorts. So I think that's why I'm saying that if I can get to 27.80 today, or 82 preferably, that would give me a 20 pip run to take 4 standards off and leave 1 on, just to see if we get any kind of movement above that 128, because it looks like on the higher time frame daily, it may want to reach up to that level, and I don't want to be looking at the trees so closely that I can't see the forest. But I'm giving you the internal dialogue, and as you can see, it's been, again, one more time, effective, pulling out what price should do from my experience. I'm pulling and drawing all my 26 plus years of reading price action to give you this stuff as it's happening. Now, obviously, you're watching this video in hindsight, but I'm executing. I've had management of an existing position here, but I'm giving you all the things that go on in my head that is missing between the lessons, because you have to see things from a conceptual standpoint, what it looks like that track in the ground, okay? Until you see example after example, and it's not just I show you a video now you understand it. It's too myopic of a view as a new trader, especially my students, to come in and think that you're just going to watch my videos and you should already know what to do with it. Now get me some signals, Michael. That's not what we're here for. I'm teaching you how to do this the appropriate and the most efficient way of learning how to do it, with the goal in mind that you're not relying on Michael. You don't want to rely on me. You don't want to have to trust what I think is going to happen in the marketplace. You want to be able to do that entirely independent. That way you're not relying on someone else to provide you the opportunities. You have literally all the opportunities that's available to everyone at your fingertips. And it literally took me seconds to see this setup. When I started the video, I just seen it that quick. I clicked the video on, started recording, and I went right at it and started explaining it to you. Now, again, don't think, because I'm sure there's some of you, there's a lot of new students in here, you're going to be probably very cynical about this. Well, look at this. We're only talking about 15, 20 pips, movement. Don't make that big of a deal out of it, Michael. Well, if you're going to discount that whole premise of what I just outlined here, you're going to fail. Okay, I'm not going to be able to help you unless you change that mindset, because everything I just did here, outlining it, framing it, is the same thing I do with every single one of my trades, regardless of the one shot, one kill, the short-term trading, swing trading, day trading. Everything that I do is the same framework. That's the reason why I taught in month one low resistance liquidity runs, because that is the hallmark to how ICT finds setups. I want something moving in my direction. I don't want it to be a guesswork. I don't want it to be, am I going to have a 50% likelihood of seeing this pan out? I don't want that. I want to be in the upper 80% where I have a lot of things in agreement with my idea of where price should go. And then I use my experience and my tools to give me points of entry to get in sync with that overall price move. So it's one thing to say, well, this isn't all that big of a deal because you should be showing me how to do that 50 pip win or that 75 pip win. I just did. Again, imagine these being hourly candles or a 4-hour candle. Every one of these candles represent 5 minutes here, but if they were representing a 60-minute time frame, there's more pips involved there. And the framework would still be what we just outlined during this video. All the hallmarks of measuring institutional order flow, it's not trend lines, it's not moving averages. I'm using price to weigh out whether there's buying and selling. Is there real accumulation, or are we entering a level of distribution? Now, obviously, there's been distribution here, but I don't think, because we have a little bit more of the daily range left, I don't think they're done, because they got real close to the 80 level, and they gave you this doji. Okay. Now, Steve Nielsen, he'll give you this idea that this is the top, and now we have a swing high because we have a lower high. We have a lower high here, so we have a potential swing point or swing high. So in the olden days, we would do this. We would put a circle, a little ring above old highs and old lows. And this would be ring highs and ring lows. And this would be an example of a ring high. Let me make it a little bit bigger. Okay, so on my charts, I would draw a little circle above that, and that would be telling me that this is a turning point. So therefore, in my mind, if this was a daily chart, that would be looking for where was the next downside swing low, and that would be right here. So that would be the next level. Is there enough room from where we are here to do a trade? Admittedly, I don't believe there is. The next one would be here. Is there enough to take a trade? Short, no. The next one would be in here. Well, not so much here. Here. And yes, there's a little bit of a range, but I don't think it's done its work yet. So if we would have hit the 80 level, then I would trade that with the run down to here, and it would make sense because we have that fair value gap to close in too. But because we fell short of the 80 level, and my personal experience tells me that there's more likelihood that they'll just bounce it around in here, maybe come back down into this down close candle, because this has got more body to it than this little down close candle. But the opens on both of those are relatively the same. So we're watching now to see if the price wants to come back down here, hit that, pick up more orders, and then have an expansion on the upside. Stop remains at 58, with the upside objective of I'm what 127.82. That's what I'm trying to get. So if I can peel off 4 lots there, that'll be a full 20 pip haul for a scalp, which is ideal, classic. If we trade sideways in here and we get into the 10 o'clock hour, and it allows me 15 pips I will take 15 pips off with 4 standard lots and then leave one on to see if we can get that run, and the stop will remain where it's at now. Okay, this is the type of price action I was hoping to see. We didn't see a sudden breakdown to confirm further distribution. Again, I like this level at this high here. So the open, we're going to watch 2767. That should be sensitive. So if we hit that and bounce, we'll probably make that run into that 80 level. Now, because we traded through about 80% of the range that we were looking to trade into for runs on liquidity, this would not be a buy. Some of you are probably thinking, okay, well, this would be a buy then. No, because it's less probability, because we're near the high of the day. We're halfway through the New York kill zone, and we've already eaten a lot of the liquidity. So this would be just like that last little management idea for the existing position that I hold. So that's kind of like a line in the sand. I don't want to see the middle of this order block violated. So that's like a line in the sand too. I want to see it hit here, show responsiveness, and then wick to the upside, expand, run the high, reach to the 80 level, give me 82, give me 20 pips. I'll take 4 off if I can get 82 and move my stop to break even and let it just do whatever it wants to do. Okay, so we've gone into the candle here. Again, I don't want to see it trade through here. That would be not good, because that would just exacerbate the distribution cycle that we're in. And this is the hardest part about trading, knowing the catalysts and expecting them to perform for you, but then also knowing where these
thresholds are. Where is the trade allowed to go against you? And there's a comfort level in knowing by experience what could still happen when it's trading against you and keep the trade alive or viable. As you can see, we have a nice response here. Mean threshold, down closed candle. That's the normal response. You want to see that. We don't want to see it come back down here and do like a double kiss of that. It's already did its work. It should eat all this back up and then go into a green candle, this candle or the next. The other thing that makes it difficult, there we go, that's what we're looking for. It's almost like it was listening to me. Luck of the Irish, I guess. Anyway, the difficulty that you encounter also when you're trading forex is when you're managing your stops. You have to be 10 pips away, and that was one of the things that led to why I teach to use the 15-minute as your bellwether. In other words, that's your go-to entry time frame, regardless of what type of trader you are, what style of trader you are, because generally a 15-minute chart will permit framework and structure to allow you to manage your stops more efficiently than what we're showing you here on a 5-minute chart. Like right now, if I want to move my stop from 58, I can go to 68, but I'm only 8 pips away from getting stopped out. So I want to give myself a lot more room than that, because you know what it's like if your stop loss is really close to the marketplace, and if you're in profit, that becomes more stressful than if you were in a trade that you were underwater and not holding an open profit, because you're panicking and worrying about whether you're going to get stopped out or not. So if we know in our rules that we're going to be looking for things to measure and gauge whether there's a good probability for it to continue, we have to keep our stop loss outside of that range where the next trigger event would be, and that's what we outlined here. We had a nice initial response. I'm not liking the fact that we weren't able to hold all this. This could be another level of distribution, because we basically went up to the midpoint of that range with this candle's high. So that could be problematic. Now, the reason why you want to keep your stop loss not so close to where the market is and where it logically would be doing its job, reducing their overall risk. Really, I have about 4 pips at risk in the trade at this point now, so it's not even that big of a deal. It's more of an ego bruise than a monetary harm. But what I'm thinking and watching in here is that, not that I'm obsessively worrying about getting stopped out. I don't care about that. What I'm watching is this order block. Is it allowing price to find support there? Initially, right now, it's showing signs. Even though we have these wicks, I don't care about these wicks because that's contrary to the underlying narrative that I've already outlined for you in this video. I believe that the draw on liquidity is up here. Anything they give as a wick or a retail resistance theory, I believe that's suspect. Okay, in other words, I'm fading that view. So there's a market efficiency paradigm that's being exercised here live with you in recording, that I'm seeing how they could see from a retail perspective all these wicks, okay, and how that could potentially be viewed as weakness. I know there's enough daily range still. It's 9:35 a.m. New York time, okay, on a Monday, and we could very easily still punch up into that 80 level. And this might be the Judas for the week. It could be the weekly high forming here. I don't care. It's just a scalp. Okay, I'm not worried about all that. But if we looked at, for instance, I'm not. There are you. Let's look at an RSI, Relative Strength Index, on a 14-period basis. It's coming up as default, so that's good. All right, so we're overbought in the view of retail. I don't see any real crazy divergence in here. The high to this here is slightly diverged. If we look at a stochastic, and what I'm trying to do is I'm getting a measurement of what retail would be seeing related to trying to call tops, like they try to do all the time. I don't see any real divergence there. Again, we're just overbought, coming back down. I like the idea, and this is something I do follow and I have a faith in. We have this low directly related to this low in price. We're coming down. If this goes below this low in the stochastics and keeps the higher low intact, this would be a trend following divergence. In other words, we didn't really get a divergence on the bear side. We could cycle down in the stochastic, go below this low on the indicator, and then that would be a classic continuation trend following signal, because it fits the narrative I said with the institutional 80 level being the draw. So this is where institutional order flow and indicators coupled together, the indicator will work then. But I was hoping I'd see some measure of a stronger divergence on the indicators in here. I'm not seeing it, but the narrative still is this is the draw on liquidity. I want to see 2782 printed, because if I get that, that gives me 20 pips. So 20 pips would be a beautiful example of everything that's been mapped out here. Not a lot of pips from down here, not a terrible amount of movement, but a predictable amount of movement. And again, the classic theory is applied to all time frames this way. And there's other ways of trading with my concepts, but this is the easiest one because this is how I first learned how to trade profitably. When I was able to find consistency, it was using what you were taught in month 1. When I adopted that frame of mind and those things that I teach you in that month, everything changed for me. And it gave me a foundation, like I teach you in the mentorship, is you want to build on that. You want to have the easiest pathway to your trades panning out. You don't want to be trying to pick tops in existing bull runs because it's too hard. If it was something that could be done consistently, I would already know it. Okay, I believe in my heart that God has blessed me with a great deal of understanding and insights. And if it was something that could be done consistently, I think He would have shown it to me. But because I've spent over a quarter of a century obsessively studying this, I've completely accepted the fact that I can pick bottoms in bull markets and I can pick tops in bear markets. And that's the only types of tops and bottoms I'm interested in terms of technical analysis. If you want to be trying to pick the tops in bull markets, I can promise you that is chasing a unicorn. You're not going to find it. You're not going to get consistency doing it. You're not going to be profitable doing it. And if you do get it once in a while or ever, it's completely and purely and utterly luck. And that's when there is a real instance of luck, because there's no way to specifically dial in on the actual high and the low, because what you're experiencing when you're trading in a bull market, okay, everything I outlined here from this order block down here, everything that I outlined is the same basis and framework that's used on the higher time frames. So a bull market is not defined a 5-minute chart. It's defined on a higher time frame, daily, weekly, and monthly. So if those time frames are suggesting that we're in a bull market, think about what that's implying. It's reaching for a level of liquidity on those higher time frames, just like I outlined this structure of this trade, this whole framework. It was outlined on the draw on liquidity at the 80 level and the liquidity above this old high. How are you going to know what level on the higher time frame, monthly, weekly, and daily, that they're going to end that upside expansion to liquidity on the monthly, daily, and weekly charts? How are you going to know that? You're not. So that's why it's important that you don't try to pick long-term highs and lows or tops and the bottoms, because there's absolutely no way to determine where the terminus is on that. Whereas if we're looking for a terminus of a corrective move, okay, in an existing price move that's bullish, then obviously there's a different dynamic there, and we can get more precise because we're trading with institutional order flow, and we'll know what they're reaching for to pick up more orders to go in line with that higher time frame, order flow. Basically, you're buying the dips and you're selling the rallies in the right context. The problem is books talk about that, and you've heard it said before, the trend is your friend. Buy the dips in the bull markets and sell the rallies in bear markets. That's easily spoken and said, but why is it that 90% of the retail traders don't do it? Because they get into this idea that, well, it's been going up forever, it has to eventually go down, so it's easier for me to sell it at the top and have more downside in my profit side, and the upside is limited against me if I'm trying to pick a top in a long-term bullish market. And that is the biggest myth in the world, because I'm going to tell you something. I lost fortunes. I lost fortunes believing that crap. Okay, I believed that I could eventually do that, and I wasted so much time and money and brain cells. Like, I was a mess worrying about all that stuff. So it's important that when we look at examples like this, we're not trying to limit your abilities or limit your scope of efficiency in trading. What I'm trying to do is keep you focused on the low-hanging fruit, the things that are easily found in price action, the things that are easily discernible in price action, the setups that form consistently over short periods of time and long time. It's the same criteria. But if you don't know what that criteria looks like on one example, and that's the reason why I like to teach with intraday, because it gives me a plethora of examples to flood you with. And the assumption is for traders that are not inclined to want to trade intraday price action because of pure tastes or time constraints that not allow them to do it, that is the the incorrect way of interpreting or viewing why I'm doing it. Because it's not your fault, because you're looking at it from a new trader. You're completely a neophyte, and I don't mean it to be derogatory. You just don't know. So when you have someone tell you with experience, this is how you learn how to trade. If you want to learn how to be a position trader, trading for 3 weeks to a month or two in your positions, let me teach you how to do it with an intraday chart. Right away, you're going to be like, what? I'm not interested in that. So you start putting up blinders. You don't want to listen to that, because it's not going to be in line with what your personal tastes are, because you don't want to be a day trader. But what you're trying to do is you're trying to tell the teacher indirectly that the teacher doesn't know what he's doing. So therefore, you suffer. I already know these things. I've executed many examples, online, showed you a track record of it. Full year, everything consistently, over and over and over and over again. I've outlined this little micro move here. This entire price action model here, this fractal, is the same thing that I would do if this was a daily chart. And it panned out over weeks for a swing trade. Think about that, because price is fractal. I'm not concerned about the specific time frame. I'm understanding where price is trying to reach for a liquidity basis. What's the framework that is behind the price move that I'm observing? It's reaching for something. Clearly, it's reaching for something. So what is it trying to reach for? And between where that is, that's the terminus, that's the goal at which the price move is trying to arrive at, okay, whether it be trading up to it or trading down to it, respective to its bias, and where price is at the time you sit down in front of the chart to see it. And if there's enough range in there that fits your personal model, I'm not saying force yourself to be a day trader. I'm saying study what I'm teaching from a price action standpoint. Notice that I don't have ADR on here. I don't have the kill zones on here. I don't have Asian range on here, because that's not the point of the teaching. The teaching is I'm teaching the draw on liquidity, because that's the holy grail. That's what everybody's missing in trading. The folks that do well and they're consistently profitable are the ones that know where price is trying to go to. They're not focused on their entries. That's not what they're trying to, their attention is not focused on that. Now, the losing traders, okay, whether they be traders that have been trying to be profitable for years, and I know people that have been trying to trade for over a decade and have never made it, but they just won't quit. I commend those individuals, because you have what it takes to be a trader. You have it. You have the tenacity, because you need to be tenacious. But if you do not have an understanding of what you're trying to do, it doesn't matter how tenacious or convicted you are about doing this as a career or a hobby, you won't make it. So what's the differentiation between those individuals that make it and those that don't? They have an understanding of what price is trying to achieve. Where is it going? And obviously, it goes back to the same things that is written in books. The trend is your friend. Okay, stick with the momentum on the higher time frame. But how do you do that as an individual? How are you going to do that? See, that's what I did for myself. I knew that large institutions are controlling price. Okay, they have a vested interest in it, and it's not that they're trying to make 20 pips on a 5 standard lot move. They're in there with billions of dollars. They have a lot to gain from it. So if they're in cahoots with one another, in other words, they're actively participating with a concerted effort to manipulate price action, and that's my firm belief, then I want to see the opportunities that promote the most likely scenario where they're going to do the most harm conveniently at a specific time of day or time, where I can look at that and say, okay, here's the opportunity. The less informed crowd can see X, Y, Z. But the underlying pinnings of the market are indicating completely and utterly something entirely different, diametrically opposed to what would be discerned by retail. So when I understood and was shown how markets are made, okay, how market making is done, not from a market maker that creates just short-term liquidity for stocks or anything like that. I'm talking about the central bank level, where the actual prices are set, okay, and completely controlled. That moment where I understood what was really going on, that's when I could see it in the chart, and I bridged that. So the things I teach, I don't teach the things I teach for the sake of being different. My concepts are different because for the sake of them being effective. I don't try to be something different. I don't reinvent things that already exist because I'm doing things that are not available anywhere else, and you see it. You have elements of it shown to you repeatedly over and over and over again. A lot of students come into my mentorship thinking, oh, well, I'm going to learn an advanced version of supply and demand, and they quickly find out that that's not the case. We turn supply and demand upside down and literally destroy it and thrash it. Supply and demand, online trading academy would love to have the precision that I teach. If I went over there and did a workshop with them, okay, they would be blown away. They would be completely it's almost didn't quite get there. Did it get there? Yeah, it got our 80 level. Now I gotta get my orders here because I might get my 82 level. I can go on Twitter and brag. Oh, Michael, you're so bad. All right, so I have 4 lots ready to go. If I can get that. Now, I'm in a little bit of a pickle here because the chart I'm showing you, okay, is printing at 2778, but my demo count is printing that I could get out at 2780. So there's a slight difference in the feeds. So I will have to hopefully see a little bit bigger move above that 80 level to get what I'm trying to obtain here. I got 2 more pips and I can get that 82 exit on my demo. But you can see how everything I outlined was delivered perfectly. The institutional level of 80. Why is it 80 to draw on liquidity? And why was I comfortable with this level of holding down here? Is because we didn't reach it here. So we engineered liquidity. Traders saw these wicks. I'm talking myself right out of opportunity to take profits. So let me focus on this because I'm going to distract myself otherwise. Now I'm watching the clock. It's just a couple minutes before 10 o'clock. I want to be taking my profits in here. I have an objective of 82, and I'm giving it time to try to expand up in there. And internally, the dialogue I'm having with myself is, I have the trade right now at profitability. My objective is 82. I could collapse the trade at 79 right now on my demo, and I would not get 20 pips. At 10 o'clock, I have to make a move because it's been one-sided all day. We hit the 80 level. We cleared up all the liquidity above this high here. So I don't think I'm going to have the probabilities on my side if I hold it longer than that. So I'm giving it until 10 o'clock because we're entering our profit-taking hour from an algorithmic standpoint. So if they want to most likely go sideways or maybe even trade lower off the daily high, and I don't want to be involved in that and erode what I have as potential gain. And the difference between the feeds is I'm 2 pips higher than this Forex.com feed that's being shown on the chart. So I'm actually in a better position price-wise in my demo. It's fluctuating between 2 and 1 pip better for me in my demo than what's being shown on this chart. I like to see it give me one more drive higher. This punch up into 82 is really what I was aiming for. I like to see them toss it up to like a gap it up into like 85. That'd be great to see that. Notice I have not moved my stop loss up. I don't want to be worrying about that too. I'm measuring whether there's enough buying strength to get up into the 82 level. Oh, it just flashed on my screen. I just had it. I was talking. I had the opportunity to get it 82. Again, it's a slight difference between the two feeds. Let's see if I can get this. So we had 3 times trade to 80. I would really like to see them drive up into that 28 big figure for today. And that would be, again, them selling the narrative that we're wicking at that level. And then finally give one more bullish drive up in there to reach for the liquidity with no come on, a little bit more. Okay, I got my 20 pips. So it printed on my demo 127.82. I'm going to tweet that so that way everything's kosher. First trade of 2019. Obviously demo. Demo baller. Alright, so now that I've taken profits, so I can move the stop up. They ain't gonna let me give you that. We'll go there. So stops at 27.68. Let me update that on my position. I don't think it's going to let me. It's done moved. I'm just going to do a 63 stop. That's basically 1 pip on the remaining balance. Yep. That'll be fine. And that is it, folks. That's how we do it. That's how it's done. Let me tweet that so everything is as I said. Okay, and that's going to be it. Hopefully you found this lesson and live example of analysis and calling it beneficial. We don't need a lot of these. Okay, the new trader or the one that is just floundering still with the content, you only need to see like one or two of these because it's the same thing. It's the same thing all the time. All I did was exercise what I taught in the mentorship here and focus primarily on just the month one content. 20 pips. It traded as we thought it would, or as I thought it would. I outlined the triggers that would be catalysts for buying and selling, what would change the structure of the trade to negate the idea. I told you why I was managing the stop, when I was managing it. I gave you the reasons where retail would see things and where smart money would be opposed to that. And obviously, when there's an arm wrestling match between the two groups, smart money is going to win. And everything I showed you here was taking elements of retail and turning it against them. And that's how I internalized the marketplace. I used the market efficiency paradigm. Where retail is looking for a sell, I'm looking for a buy. And where retail is looking for a buy, I'm looking for a sell. Everything I'm looking for is in the context of liquidity, where the orders would be, and I measure institutional order flow with the candlestick structure in sync with where I believe the narrative is for price. So where's price reaching for? That's our first question. We have to know what that is, because if you don't know what that is, you have no business even considering taking a trade, because it's not just simply this looks like a buy because it's giving me an indicator signal, okay, or it's trading at an old support level, so it must be a buy. No, you have to discern what price is reaching for and understand liquidity. Markets are going to move where the orders are. They're not going to move based on indicators or entry patterns. That's not what moves the market. The market moves to where the orders are. Where are those orders going to be? They're going to be, as I teach them, in liquidity pools, above old highs and stop sweeps of 10, 20, and 30 pip grades, reaching for institutional levels, as it's been shown here today. Everything I outlined is exactly what you see here. So hopefully you found this insightful. Until I talk to you next time, I wish you good luck and good trading.